Hello everyone, and welcome back to the second part of this video, analyzing a Markov chain approach to modeling stock market trend transaction based on probability of movement between the bullish, bearish, and stable states. Are you excited to move forward? Yeah, I guess you are. Let's go. My name is Stanley. I'm the founder of Stanalytics, and in this video, I'm going to be working on the analytical aspects, including the codes and the reports of the three stocks we are working on, which are the Netflix, the Apple, and the Microsoft, their trend, and as well as the probability of moving from one state to another. And I'm going to guide us through the codes and how I was able to approach it. So this is our objective of the study. So we are basically classifying the stock price into the bearish, the bullish, and the stable state using defined threshold. We are going to estimate the transition probability metrics. I'm also going to determine the long-run stable state probabilities of occurrence for each market state. So in the previous videos, I went more deep into this particular concept, why we are doing it, motivation of the study, and every single part. So in this particular video, I'm really going to be diving deep into the analytical aspects, the data sets, explaining each concept, and then we move forward. Yeah, so this is my data sets, and these are the three stocks I'm working on. I'm basically working on Apple stocks, the Microsoft stocks, and the Netflix stocks. So I am not going to be working with the Google stocks. And the reason why I decided not to work on the Google stocks is because I'm working with the 3x3 transition probability matrix. Because it's not possible to work with the 3x4 transition probability matrix in Markov chain. It doesn't work that way. And although there are more technicalities and some statistical reasons to it, but I'm going to ignore it in this particular video as it is not in the scope of this particular study. So these are the stocks. The date column represents each particular daily observation. So this basically means that okay, let me format it so you can understand how it is. Yeah, so this is 7th of February, 8th of February, 9th of February, 10th of February, and the 13th of February. So this is basically from the 7th to 28th. So basically what I'm trying to say is that this particular stocks, Apple stocks, was traded from the 7th of February to the 28th date to the 31st of March. Okay, sorry. Still trades till April to the 5th of May actually. So from the 7th of February to the 5th of May, then we proceed to the Microsoft stocks, which we stopped trading the 28th of February as well. And then yeah, so Microsoft stocks was traded from 7th of February and we stopped trading it at the 28th of February, sorry. Okay, basically extended to 5th of May, and why the Netflix was traded between the 7th of February down to the 5th of May as well. So basically the way data is structured is that it takes each stocks separately. So it takes Apple stocks and then show us the data sets, the information regarding Apple, then ends here, and then starts with the Microsoft. And that's why you can see that the date keeps changing from 7th of February as well. So basically we started trading all the stocks at the 7th of February. Same goes with the Netflix. Yeah, 7th of February, and majority of them was stopped at the 5th of May, as you can see. Microsoft as well. The 5th of May, and Netflix also 5th of May. So you can see. So we started trading the stocks at the 7th of February. And this stop date, the day we basically stopped trading this particular stocks was on the 5th of May. So just was to keep track of that basically. Now, for join me as I move on to the codes behind it, as well as developing the transition probability metrics. So basically, in this particular scenario, we've done the data cleaning. We've done the missing values, remove the duplicates, and every details that needs to be removed. So this open colon basically means the price at which the particular stocks was basically like the price at which it started this particular day. So on the 7th of February, the stocks is basically um, valued at $150.64 when we opened the trade, and it attained the maximum value at $155, the lowest value at $150, and it was closed at $154. And this is the adjusted closed, as well as this is the volume of the particular stocks that was traded that particular day. So I believe I've defined the column. These are our stocks basically, and these are the dates column. So join me as I move on to the financial probability metrics development as well as the analytical insights generated from the stocks. Yeah, so basically in our programming, what you are going to first of all do is basically install our packages and make sure they are well loaded. And this is it. So deploy R, these are for data cleaning and data manipulation. This is for data visualization. This is to make sure our data type is well aligned. And this is basically the main library we need to run our Markov chain. So moving on, we imported our data sets, right? And then we examine the structure of our data sets, which is here basically. Yes. So and then we checked the normalized stock price trend at this particular scenario. So you could see the trend at which three stocks are following. As you can see, Apple stocks and Microsoft stocks basically dipped from March to close to April before it started rising, while Netflix basically experienced a dip till a more deep, and I explained this in details in this particular report, which I'm going to be showing us now. So as you can see, here this is basically so the three major technology stocks is over a three rough window, which stocks price normalized between to 1.0 basically. I'm going to explain that as well. So the Apple stocks and the Microsoft stocks, okay, these are not as important as we need. So now Apple and Microsoft stocks dips modestly in early March. As you can see here, you can see the fall, the decrease in trend before recovering and climbing steadily through April. So April is when it started, this recovery phase, as you can see in this particular scenario, and then started rising in May. So, and by late May, Microsoft has actually pulled off slightly ahead, finishing 14% above its starting value compared to Apple's stocks, roughly 11%, while the Netflix in particular spent almost its entire time period dipping, basically like it's kind of falling and dropping. Like I said, it drops basically from February to mid of March, and it's doing nearly 18 to 20% of its normalized stock value. So and then it started its recovery phase around April, but it was not insufficient to close the gap. Like it was not able to match up with the other two stocks. Then moving on, we also got the closing price trend as well. As you can see, is kind of identical to the opening price trend. Yeah, so and that's why I wrote it here that basically it's more of a comparison, looks the same comparison of three stocks as the previous graphs. So and okay, so we're able to conclude that Apple stocks and Microsoft stocks are basically strongly correlated to each other. That is, they move in the same way, and the entire graph, yeah, it's correlated in the entire graph. So I also concluded that Netflix has followed the same pattern as it was in the previous one. As you can see, that lost 0.8 to almost 18% as well at the end of March. Then I also developed the moving average stock prices as well. So this moving average stock prices shows the moving average at week 7, sorry, at the 7th day period, that is 7 days after we started trading the stocks, 14 days after I started trading the stocks as well as the closing price for each particular day. Yeah, so yeah. As you can see, the stock shows actual closing price along its 7-day moving average and its 14-day moving average. So as you can see, so then also check the volatility. Then I will now start moving to my objective of the study, and this is where the Markov chain comes in, as well as the transition probability matrix. So join me as I explain this particular part, as this is what we are most interested in. So what we're doing here is basically trying to define the states, three states that are going to be existing, which are the bullish, bearish, and stable states. And I also made mention that we are not going to be examining the whole stocks. So then I so my first objective basically is to identify and categorize the market states of these stocks, basically based on their daily behavior. Okay, let me widen my screen so you can see it. Okay, yes. And so basically how it works is that it simplifies the behavior of the stocks by defining its daily returns in specific market conditions. So basically what it does is, in calculative terms, it is let me write it down here. So divided by the opening price. So this is the closing price, the price at which it is closed at that particular day, minus the price at which it opened divided by the opening price. So if this calculation is greater than 0. So for example, if this return is greater than 0.01, it is bullish. If it is negative 0.1, if it falls at negative, that is kind of dipping. So less than 0.01 or negative basically, then it is bearish. Then in between, then it is in a stable state. So that's how it works. And um now the reason why I did this, although there are two ways to do it, you can just use this one particular one, or you do it like this. Today's opening price, current opening price, minus yesterday's opening price, divided by the current opening price. So this is why I did it this way, is that, so okay, there's a mistake. It's actually current closing price minus yesterday closing price divided by the yesterday's closing price. Okay, so the reason why I used it is because of my focus was on intraday price movement, basically, which captures how the stocks behave within each trading day rather than across days, and it still provides a consistent percentage return measure basically, which I then use for state classification in the Markov chain. So basically what I did was that I used intraday returns. So the closing day, closing value, closing price basically minus the open price divided by the open price to capture within day movement rather than close to close returns, which captures the day-to-day movement. Okay, so in case you get that, and then yeah, so let me show you the transaction probability metrics I really got. So this is the transaction probability metrics. So the probability of this particular stocks from moving to bearish state is 0.177. So basically all these row must amount to 1 or else there's an error. So this is the code behind it, although there is a sense of coding behind it, it's like clarification and everything, but I cannot spend the whole day because it's going to take more time and this video is going to be longer than this. Then I wrote my basically what I said is that the stable state occurs most frequently, as you can see, which is 59.68 times. So most of the within that particular period of time, majority of our stocks, our returns fall between 0.01 and negative 0.01 and positive 0.01, as indicated that it is more in the stable state. And yes, and 37 observations basically, followed by the bullish state, which is 14 observations, and then the bearish state, which is 11 observations, suggesting that Apple experienced relatively price preference within the study period. So I was kind of doing it separately. So as you can even see it visually, majority of those particular stocks fall within the stable state, and Apple experienced the most stable state period, followed by Microsoft, and then followed by Netflix. And you can also notice that the most evenly distributed transaction probability metrics, evenly distributed stocks states within the specified time period of March to May is basically the Microsoft, as you can see. Then I went ahead to visualize it basically, and then my second objective is to the transaction probability metrics move from one state to another based on the observed occurrences in the stock market. So what I'm trying to do is that I'm basically trying to simulate the stock market dynamics by modeling the probability metrics between the set of identified states using the framework of Markov chain now. And I'm going to do okay. So okay, now following the observed state transition in data sets at this time closely, this is basically the mathematical terms. So my examining transition probability metrics. Okay, now this basically probability of move from bearish to bullish to stable states, so across the specified time period. And I'm also going to show us the code behind it and how it is done. So this is the transition probability metrics, and this is the code responsible for it. Of course, like I said, they're going to install our package, our library of Markov chain, but like I said, I cannot explain this whole codes because it's going to take a lot of time. I just want us to understand the concept of the project as well as the concept of Markov chain. So as you can see, this is the transition probability matrix moving from one state to another, and I'm also going to show us the reports and everything I did. So to make this video as short as possible, I won't be talking about the third objective, which is on the long run probability. Yes, the long run probability. So okay, so what I was able to notice was that the stable state is the most persistent, accumulating 47.78 percentage basically, that the probability is going to remain stable given that's okay. So let me rephrase it this way. The stable state is most persistent because it has the highest probability of occurring. So it has the highest probability of remaining stable. So what this transition probability matrix does is that the probability of moving from one state to another. So the probability that is going to remain at the bearish state, given that it is previously at the bearish state. So for example, today it was at the bearish state. What's the probability that is going to become is still going to remain at the bearish state tomorrow? So the value is 21.28 percentage. So from bearish to bullish, the next day is 21.28 percentage as well, which is the same probability. And bearish to stable is 57.545 basically, so 0.5745. Then we from bullish to bearish is 0.39. From bullish to bullish is 0.36. from bullish to stable is 0.3913 the following day basically. So from stable to bearish is 0.28, from stable to bullish is 0.233, while from stable to stable is 0.4778. So, and these are the implications. Markets will remain stable to neutral for a considerable amount of time. So, then the third one is the long run potential probability matrix, which, okay, I'm not really going to explain here, but I'm not going to show us the code basically. I'm going to make a separate video for it. So, thank you very much for watching, and I really appreciate your time so far. Do have a wonderful day.